Making Democracy Work, brought to you by the League of Women Voters. Every month we take up topics of community interest, and this month we're going to take up REITs, R-E-I-T, Real Estate Investment Trust, and their status in Hawaii and their tax status in Hawaii. So we have with us people who are going to talk about this. Peter Savio, the well-known real estate investor, and Roger Epstein.
The unknown tax lawyer.
No, but you're doing something else now, right?
Oh yeah, I'm an international business consultant these days. I retired after 50 years as a corporate tax lawyer.
I see.
I started when I was 5.
All right. And I am Pearl Johnson of the League of Women Voters, and my co-host is Kaui Lucas. Thank you very much, all of you. And who would like to talk about REITs first?
Peter.
You're the smarter one. Well, REITs are a type of corporation that invests in real estate. They're supposed to hold the real estate and produce income from it. And the concept is that they pay out 90% of the income, the net income, to their stockholders. And in doing that, it's a tax-free transaction. In effect, they pay no state taxes. They pay federal taxes, or their stockholders pay federal taxes, and they pay state taxes on the state they're in. But for a state like Hawaii, where we have a very active real estate market, we have a lot of REITs in investing in Hawaii. Per capita, we probably have the highest number of REITs investing. So we actually lose probably close to $60 million a year in tax revenue. And for a state our size, that's a lot of money.
Let me be a little more technical, because I'm the technical person.
You're the lawyer.
That's
I'm
right.
the technical lawyer person. So basically, everybody pays an income tax in Hawaii, as well as a federal tax, a Hawaii income tax. The rates for corporations are 6.4%, and the rates for individuals are 1.4 to 11%. So there are two levels of tax. There's a level at the corporation, which I said was 6.4, on the money the corporation earns. Then the typical corporation distributes whatever's left, or some portion of that, to its shareholders. And whatever they distribute as a dividend, the shareholders pay their own income tax. So Hawaii is supposed to collect a corporate level tax and then individual level tax. Now, the REITs were set up in the 60s, and the idea was like a mutual fund. Small individuals can invest in a wide variety, a diversity of stocks and bonds, because they don't have enough money to buy those stocks and bonds themselves. But if they put it into a mutual fund, the mutual fund can buy a whole variety, and it makes it safer, and it allows you to invest. And so the mutual funds, what they do is they don't pay any tax. Whatever they earn in interest and dividends, they give to the shareholders, and the shareholders pay tax on it. So mutual funds been around for a while. In the 1960s, the real estate industry said, why don't we essentially create mutual funds for real estate? And then the average guy can put in 1,000 or 5,000 or 10, and he can participate in the real estate development market. So that was a nice idea. And they said, okay, what we're going to do, we'll set up these funds, these REITs, so that they can only invest in real estate, and they have to distribute at least 90%, but they actually distribute 100% of their income. So it's like the REIT earns $1 million, okay? The law says, okay, don't pay the corporate level tax, that's 6.4%. You don't have to pay that, as long as you give all the money to the shareholders and let them pay a shareholder tax. And there's a lot of reasons for that. Most people in the real estate business, Peter for one, he's got it set up so he's not a corporation and a double taxpayer. He sets it up so that he only pays one tax. So the concept was, let's just pay one tax. And at the federal level, it works because everybody pays federal tax except foreigners. And they set up a special provision to get the foreigners, okay? Now, on a state level, the problem is we're not all living in one state. We're living in a bunch of different states. So when the REITs come here to Hawaii, this is Hawaii. When the REITs come here to Hawaii and they buy up these real estate, and we'll show you what they own some of the most valuable, well-known properties in the state. They earn, let's say, $1 million. Okay, so what the law provides is, in order to put all this together, pay out the $1 million and let the shareholders pay the tax. So there's no 6.4% Hawaii tax. And when the money goes out, the problem is that 97 to 99% of the shareholders live someplace else. So we don't get the corporate tax, and we don't get the individual tax. And that's the problem that Peter and Peter had been looking at this a lot longer than I, but I jumped in to try to help to see if I could solve the problem from a technical standpoint. But is that clear what's going on? The REITs make this money. They're supposed to pay state tax, but they don't pay because the law says if you distribute to your shareholders, they're going to pay, but the shareholders don't live here. So they may be paying in California.
Maybe,
other
or
states.
must they?
Well, it depends on whether there's a tax law. Not all states have income tax. If you live in Nevada, you don't pay any tax.
Wow. Okay. So you mentioned, let's bring it home in a more concrete way. Let's look at, you generously provided us some information, so we'll go through that and we'll look at some of these properties here in Hawaii that are REITs. It's shocking. It's shocking. So this is a little review of what Roger just said.
There's actually $1 billion of income that's escaping state of Hawaii tax, roughly $1 billion of income. And that's $60 million, as Peter said, $60 million a year that Hawaii hasn't been getting. Peter's been trying to get that money for the last 5 years, which would have been $300 million.
This is the first time I've ever heard that our government has been slow to raise taxes.
No,
Okay.
they're not even raising it. They're just not collecting it.
Okay, so then let's go to the next one. Okay, here's a partial list. Really, really shocking.
Ala Moana Center. Now everyone knows how valuable that is.
Pearl Ridge Shopping Center, the Hyatt Regency in Maui. Look at all those Hyatts and Hiltons, and we have some maps about that. Let's forward on.
Hilton Hawaiian Village.
Mapuna Puna. Wow, those are the former Damon estate.
Pearl Ridge Shopping Center.
So all over our islands, really.
Oh,
And then downtown.
Office buildings and shopping centers are what the REITs are required to invest in. And the idea, again, was to allow you to put $5,000 into a basket of those properties that you couldn't possibly otherwise participate in. So the idea is not bad. Our point is, why are they the only ones who don't pay income tax?
Right.
And it's a quirk, it's a fluke in the tax law.
But it's been a very resilient fluke.
Well, the REITs fight very strongly to keep it. So you get a lot of opposition when you try to change the tax. And again, like I say, we've been working for 5 years, but it's been a grassroots, 5 or 6 businessmen. And we got to operate our businesses. We don't have the time to spend a lot of working at the legislature and hiring people to go down and talk to them. The REITs, they hire the lobbyists, they bring people from the mainland, and they really work at preserving their exemption. I think one of the things that fascinated me about this is Hawaii adopted the federal tax code as our tax code. And in doing that, there's a sentence in there about REITs are tax-free. So that's really what happened. We adopted the federal tax code, and I'm sure we realized it was in there, but never thought about it. So really the amendment is just to remove that exemption so they're treated like everybody else. And to me, that's fair. I think there's a a moral obligation for a state our size where you're earning or not paying $60 million in taxes, and we have problems with homelessness. We have problems with our schools. We don't have enough money. And the $60 million they aren't paying, we're all paying. Our taxes are higher because they're not paying. So
Let
it has to be right.
let me present you the REIT side a little bit. What they're saying is we've brought a ton of money into this state for development. If we didn't bring this money in as REITs, then you wouldn't have jobs. You wouldn't have all the general excise tax that comes from businesses and shops, and none of this stuff would exist if the capital didn't come in to the state.
Does that mean that they built the Ala Moana Shopping Center and they put in the money to build the Pearl Ridge Mall?
Actually, they didn't.
I thought not.
Yeah.
So,
And Peter has something to say about who would be investing.
Well, I think the key is what he's saying is true. That's what the REITs do. And they're a great vehicle for investing. But the reality is other corporations, other private parties would do the same thing and they'd pay the state tax.
right.
So what's the advantage of the REIT? You know, an insurance company will buy, a wealthy family will buy, a large corporation will buy. They don't take advantage of the REIT tax benefits. So again, every argument the REIT makes, a private corporation does the same thing. They bring in the money, they create the jobs, they do all of those things, and they pay a state tax.
Well, thanks for being fair. Roger it was nice of him to step in and do that. I did contact the National Association of REITs and invite them here on the show, and they declined, just FYI.
Yeah.
So.
Well, here's the other part of it. Of the 50 states, 48 plus Hawaii have agreed not to tax REITs. So you say to yourself, why is that? New Hampshire did this 15, 20 years ago, and no one has followed suit, no other states. So the REITs make the point, look, if Hawaii is going to be an outlier in this, then people are going to invest in REITs that go other places. We're not going to get the money. It's not fair. So, as a tax lawyer for years, I looked at the problem and I said, wait a minute, there's two solutions. REITs don't pay tax. They don't pay federal tax. But all their shareholders pay tax. Our problem is we're not getting the shareholders to pay the tax. We're not unhappy that the REITs don't pay a double tax. We just want it either from the corporation or the shareholders. What does the federal do when the shareholders live out of the country? They have a withholding tax. This is the same as the employee withholding tax that every one of us pay. When you get paid $10 an hour, you only get $8 because some of that $2 goes to pay your tax. And when you file your return, you're paid up. So I came up with the idea last year, why don't we look at the other side of this so we don't have to say, oh, we're doing it differently than there. We're not following the federal rule, which says corporations that are REITs don't have to pay tax. Why don't we just withhold? And so that's the second way to solve the problem. And the REITs, I thought, would be happy. Nobody's ever happy, especially not if you got to pay any taxes. Because what's happening now is shareholders in California and New York, most states do have an income tax. They're paying tax on Hawaii real estate income as distributed to them by the REIT. So when they're sitting in California, California, just like Hawaii, says, all the money you get from everywhere, you got to pay California tax on if you're a California resident. Understand that? If you're a Hawaii resident and you make money in New York, you got to pay tax in Hawaii. Now, if you made the money in New York and New York said you got to pay a tax, then you go to Hawaii and you say, I earned this money, I got to pay Hawaii tax on it, but you got to give me a credit for what I paid in New York. That's my proposal. When the California guy gets the money, he says, California, I earned $100 in Hawaii, but they made me pay $5 tax on that. And so you got to give me a credit for that. And that's how the systems, that's what the feds do with foreigners. If
Do
you're,
any other states have that withholding?
none of them have it.
I see.
None of them have it. So now there's another argument. Why should we be an outlier in the withholding?
Let's talk about the corporate and the individual tax rates.
Okay.
So a corporation would pay what kind of percentage?
They pay 4% on capital gain income and 6.4% on ordinary rental income. So an average of, say, 5%, somewhere in that neighborhood, maybe closer to the 6 than the 5. So I had a proposal that said, when we distribute out this money, let the REIT just take 5% and give it to the state of Hawaii on behalf of all their shareholders. Just give them 5%. It doesn't, it's the same. If they
Sounds
made
easy.
$1 billion, that would be $50 million that we would get. Now, it gets a little complicated, and then they say, oh, it's too complicated. Too complicated. I'm thinking, it's too complicated to get $50 million a year? I'll work through a couple of complications for that.
Well, the program that we started with and the one we're pushing this year, not that we don't love his idea, we think it's a little more complex than the state is willing to accept. So our proposal is simply change the existing law by removing that one little paragraph that says they're exempt. And then after that, and we're collecting the taxes and everything, then go to what Roger's suggesting, because that makes sense. Because I think his plan is going to be, it's actually probably an easier and a fairer plan, but I think it's going to create complete confusion at the legislature. We're just saying change the law, take out the one paragraph is simple, and we will be collecting the money. Because if the other plan gets challenged and it takes a few years or it takes 3 or 4 years to get through the legislature, we're losing $60 million a year. And that's what happened to us. Just explaining it to the legislature took us 4 or 5 years. Now they seem to have gotten the concept. More and more people are hearing about it. Our problem, again, is we're small business people. We didn't spend money for TV commercials and everything else, so we didn't get the word out. This year it's out.
I heard about you at Church of the Crossroads at a faith action meeting, so very grassroots. And
Well, that's what we did this year, so we finally realized we need the support, so we went out and it's
So I'm
working.
the artist in the group. I like to think of myself that way, even though a lot of people think of me as a rich, crooked tax lawyer. So I spent 45 years as a senior partner with the largest law firm in the state. I've represented every large corporation in the state and many multinational corporations in my 45 years and 5 previous years with the Internal Revenue Service in Washington, D.C. So I see the arguments on all sides. And to me, the correct answer is this withholding tax. And so we're losing money. I like to see us not lose the money. I'm trying to do what I can to get what I think is the correct and fair solution. And I would like to enlist, and I'm on TV here, to enlist some of the REITs. There's some local REITs. Let's be reasonable. Let's try to find an answer. There's a organization called the Multi-State Tax Commission, which tries to make the law uniform, the laws of state tax laws uniform throughout the country. I think we go to them and say, why doesn't everybody do this the proper way? You see, this is not so much about how much tax is paid. It's more about which state gets it. These kind of fights over which state gets the tax money go on all the time. New York City had a big battle with the people from New Jersey and Connecticut. New Jersey has a very high income tax. 2 million people go into New York City every day and earn a living from New Jersey. And so New York says, you're making all the money here. We want the income taxes. See, so that goes on all the time, those kind of battles.
so let's talk about it locally. So you mentioned local REITs. Can we have some examples of local REITs?
Well, Alexander and Baldwin,
What?
They just converted, didn't they?
they converted 2 years ago. And Jay Scheidler, his company is a real estate investment trust. I don't know how all of his companies, but some of them are real estate. They're the 2 local, and they're such good citizens in the community. A&B was one of my best clients for years and years. Some of my former partners are still executives
So
down there.
the same company for generations was paying taxes, and 2 years ago they reorganized, and now they don't. Is that what you're telling me?
I'm telling you that.
Yes.
Wow.
And I said to them, well, why can't we get your shareholders to pay the tax in Hawaii where the money's earned? See, this source of income. Well, if the real estate's here, this is the place where it should be taxed. Nobody questions that. No question about that. But there's a lot of complications that make it difficult to implement that. And that's probably why it didn't go into the law in the first place.
Peter, is there a bill being considered in the legislature right now to implement your idea?
There are two bills. One
Yes.
involves Roger's idea of having it withholding tax, and then the other bill is the one that Mike Ferguson and I are supporting, which is the one we've always put in, just saying we want the change made, we want to collect the tax, and once we're collecting the tax, then let's work on Roger's bill. We see Roger's bill as being a fair solution down the road, but we're afraid if it's adopted, we're going to get bogged down in all the computations. How's it done? Is it legal? What's
Right.
allowed? And then, unfortunately, you get attorneys involved, and even though it's a good idea, the REITs are going to fight.
Yes.
It's for them, you know, it's 60 million in Hawaii. Imagine if every state decided to take the tax. Okay, for them, it's not, like you say, the people are paying the tax somewhere. The problem in Hawaii is we're so small, we have so much investment in REITs, or they own so much property here. 60 million goes out, but just a couple million go to stockholders here in Hawaii. The rest is lost.
Okay, so Peter, remind us what your solution is.
Our solution is to change Hawaii's tax code and remove the exemption that allows REITs to disperse and not pay taxes locally.
So
they
his solution
instead-
is to have the corporation pay their own tax.
Right.
My solution is to collect the tax from
the
the
stock.
shareholders. That's all. And you know, I've been on the side of the REITs here for a little bit in the sense of fairness, but I have a huge sense of what's going on in this country about corporations dominating everything. And this is an example where the money that the REITs have to keep the law from changing is costing everybody else a lot of money. I'm doing this work free. I wouldn't have been doing it 3 years ago when I was getting paid by the REITs to figure out how to save taxes and all kinds of other things. And so it's not fair. And I look at what's going on in the national situation, where basically we just changed the tax law to give more and more benefits to owners of businesses, to developers. And take it away from employees. Do you know if you're an employee now and your company gives you a free parking space, you got to pay tax on the value of that? Yet they cut corporate taxes from 35% to 20%. What are we going to do in Hawaii? We've got the homeless, all these problems. So I'm saying, I think we're out of balance between the value of capital and the value of labor. When I talk to the real estate REIT people, they say, we're bringing all this capital in. You wouldn't have jobs. You wouldn't have anything if we didn't bring this money into the state. And that's the argument. And I'm not saying they're not doing something good, but the workers are doing something, and it's our community, and we're way out of balance now. And this is a good example. It's a very limited, narrow example of how corporate power and corporate money and corporate domination keeps something from happening that makes sense and is fair.
But the REITs argument also is not true. It's true in the sense they bring a lot of capital, and the capital is put to good use. But there's other companies, insurance companies, investors that would do the same thing, accomplish the same thing, and pay taxes. So a lot of the arguments the REIT uses are true, but the other side is, but if a private individual did it, they'd be paying taxes. If the insurance company did it, they'd be paying taxes. You know, if this investment company did it, they're not a REIT, they'd be paying taxes, and they do the same thing. They bring in the capital, they bring in the expertise, everything. The reason for converting to a REIT is to avoid the taxes.
That sounds, that's what I keep hearing, because when I look at that list, those weren't built by outside investors necessarily coming in and doing it. Those were already mature properties that were then bought by REITs, or like A and B.
Correct.
You cannot say that A and B assets were
One of the
result.
local executives I talked to said, well, General Growth, when they owned it, they're a REIT, they put $2 billion into developing the Ala Moana Shopping Center.
But Peter has a
expended.
big point, that he has been trying to educate the legislature for 5 years. And so your idea is something new, and how long will it take to educate the legislature to pass that?
Well, I'm
And
73.
so I
If they
am
get there
all for-
before I'm 100, I think that's great.
But I am all for passing a piece of legislation right now.
Right.
So I'm with you, Peter.
Well, thank you, Pearl.
Let me also
It's
say
not
this.
an either or.
in defense
it
of
sounds
myself.
Like
It's a
both
first and a
and.
second.
In defense of
Yes.
myself, what I would like to see, and one of the reasons I'm here talking about this, if we get the loggerheads, whether the legislature is going to do it or the people with the power can keep some of the maybe my solution is a compromise that people would jump on.
Well, Roger,
that's what-
you've had a lot to say, and we're almost running out of time. So,
The power is with the people. And if the taxpayers in Hawaii will call their senators and representatives and say, tax the REITs, it will happen this year. It will happen. We need the public to step forward and say, come on, be
Let's
fair.
do this.
now,
This
is
seems
there a petition out?
Faith Action has a petition they're circulating. I'm sure it's on their website.
All right, so do you know about the petition, Kaui?
I know about the Faith Action. They have a whole program, actually, of different things, including the petition. So if the Faith Action is an organization that is faith-based, but
All right,
ecumenical.
give us their website address.
I'm going to guess, faithaction.org. They recently changed their name. It's the old Face. So Faith Action, I think if you just Google Faith Action Hawaii, you'll get there.
Yes, and so I think it's really a good idea for people to get involved with this, because remember, we're paying the taxes that they're not paying. And so if you take action, we might get something done this legislative session.
Let's do it. I'm
Thank
ready.
you.
Let's go.
I
Thank you
agree.
both for coming.
Yes, so thank you, Peter Savio. I think everyone knows the name. And Roger Epstein, who,
You're a bad boy, Roger.
and I thank you for watching. I'm Pearl Johnson with the League of Women Voters, and my co-host is Kaui Lucas with the League of Women Voters. Thank you.